Thanks everybody for joining. My name is Bill Neville. That's me in that little picture. And we're going to talk about, with being in the middle of tax season here, we're going to talk about the rules around what you can and can't contribute to a traditional and a Roth IRA. Before I get started, I'm legally required to read this to you. The Entrust Group does not provide investment advice or endorse any products. All information materials are for educational purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. And in this particular instance, what we're going to be talking about with the rules around IRAs and what you can and can't contribute, et cetera, I just want to point out I'm not a CPA. I'm not an accountant. So ultimately, what's best for your situation should be discussed with a CPA. But I'm gonna go over the different rules, but I just can't be more clear about that. I'm not an accountant. So if you want to get into the nuts and bolts of your specific situation, you should talk to an accountant about that. Talk to a CPA about that. Just what we're going to go over, a little bit about Entrust, the tax deadlines that are coming up. Talk a little bit about individual retirement accounts and the contribution rules, what's considered taxable compensation, what is compensation that allows you to make contributions to retirement accounts, how to get the most out of your tax refund, and then just a little bit about self-directed IRAs in general, and then how you can get started opening a self-directed IRA. And then lastly, question and answers. You feel free to, I'm going to answer the questions at the end. Feel free to type your questions into the chat box, and then I'll get to them as I get to the end. So a little bit about Entrust for those who don't know. We've been in business for 35 years. We administer what are called self-directed retirement accounts. And a self-directed retirement account it's an industry term. It's basically a marketing term that means that you can take your retirement account and you make all your own investment decisions, and you can hold alternative assets. You can invest in things aside from just the traditional stock, bond, mutual fund market. So if you have E-Trade or Scottrade or somebody like that saying you can open a self-directed IRA with them and then pick your own stocks, you're still limited to stocks, bonds, and mutual funds, whereas the true self-directed IRA allows you to hold alternative assets like precious metals, real estate, private equity, promissory notes, trust deeds, tax liens, pretty much anything you can think of. We've been in business for 35 years. We have roughly 20,000 accounts. We hold about $2.7 billion in assets. And we're big on education. If those of you who are regular attendees of our webinars, we do these monthly. They're all about education. We are also the only company in our industry that is certified to give a continuing education course. We provide a continuing education class. We train people in our industry, our competitors, to be certified IRA service professionals, which the majority of us in the company are. And then we have a continuing education class that we do for both realtors and CPAs. So we definitely feel like we're the leading educator in our industry because of that's what we focus on, and we've got the accreditation to back that up. So a little bit about the tax deadline. So typically it's April 15th unless it falls on a weekend, and then they make it the later of that. So tax deadline this year is April 18th. So what that means is that you have until April 18th to make a contribution for 2016 tax year. So you can use a contribution to reduce your taxable income and then grow it on either a tax-deferred or tax-free basis. So with a traditional IRA, you make a contribution, you get a tax deduction when you make that contribution, and it grows tax-deferred. With a Roth IRA, you make the contribution, it's post-tax contribution. You don't get the deduction when you make the contribution, but it grows tax-free. So a little bit about traditional IRAs. There is no income limit to making an annual contribution. You can make an annual contribution no matter what dollar amount that you make to a retirement account. You have to have, if you want to contribute the maximum, which is we'll get to it, $5,500, you have to make at least $5,500. If you only make $2,000, you can't contribute $5,500. It's potentially tax deductible depending upon your income. That starts to phase out if you make a certain amount of money, and it grows tax deferred. That means at some point you will have to pay taxes on the earnings that you get from an individual, from a traditional IRA. When you take that money out as a distribution, then you have to pay taxes at that point. Once you reach age 70 and a half, you're subject to what's called required minimum distributions, and you're also not allowed to continue to make contributions to a traditional IRA at the point that you reach that age. Roth IRAs have income limits as far as being able to make an annual contribution, but there's actually a pretty easy workaround with that I'm gonna give to you as we get further along. It's tax deferred growth unless you meet certain qualifications, and then it's tax-free growth on the earnings. And those qualifications are that you have to hold the account for at least 5 years. You have to have a Roth IRA for at least 5 years and reach age 59 and a half. As long as you meet those two qualifications, then all the earnings that you have in a Roth IRA is completely tax-free. You don't have to pay taxes on the distributions that you take after you reach 59 and a half and have the account for 5 years. The contributions are not tax deductible, so when you make a contribution, you don't get to deduct it on your taxes like you do with a traditional IRA. And there is no age limit. You can continue to make contributions to a Roth as long as you have earned income, and there's no required minimum distribution with Roth IRAs either. So, are you eligible for a Roth IRA? As mentioned, there's no age limit. There's taxable compensation is required, so you do have to have taxable income, and you are subject to income limits. You can make it if you are married filing jointly. You can contribute, like if it's a one-income household, that one income can contribute for both spouses, for both individuals, the husband and the wife. But you have to file joint tax returns. So here's the income limits for Roth. So they begin to phase out for 2016. If you're looking to make, if you're single, it begins to phase out at 117 and you're ineligible at 132. 2017, it's going up a little bit to 118, 133, and then married filing joint. Married filing separate, it's virtually impossible. They begin phasing out basically immediately. If you make more than $10,000, you're married filing separately, then you are unable to contribute to a Roth IRA. But as I mentioned, there's a workaround with that I'm going to tell you after I show you, after we talk about traditional IRAs. For traditional IRAs, again, you can't be, once you reach age 70 and a half, you can no longer make contributions to those accounts. Again, taxable compensation is required. You do have to have taxable income in order to make the contribution. There is no maximum income limit, and it is subject to, your income must be subject to Social Security tax, or the distributions, and you must have earned income. And again, spousal contributions, if you're filing joint tax returns, then if there's one working spouse, they can file on behalf of both parties. So here's the income limits for a traditional IRA. So what that says is that you can still make contributions when you're above the dollar amounts listed on here. You can just no longer deduct it from your taxes, right? So if you are in 2016, you're single and you're modified adjusted gross income, so that's on your tax forms, that's after you take out certain deductions, exceeds $61,000 if you're single, then you can't deduct. They start to phase out being able to deduct the contribution that you make. 62 to 72 in 2017, and then you can see what it says for married filing joint and married filing separate. Again, married filing separate, basically it phases out at $10,000. The workaround as far as a Roth contribution, if you make too much money to be able to contribute to a Roth, then you're probably going to make too much money to contribute to a traditional and take the deduction, right? You can still contribute to the traditional, but you just can't take the deduction. So the simple workaround is make the contribution to a traditional IRA and convert it to a Roth. And that's a pretty easy, pretty straightforward loophole in terms of being able to make a contribution to a Roth IRA even though your income exceeds that. And again, I'm going to repeat that. Just simply make the contribution to a traditional IRA. You're not going to take the tax deduction that just immediately basically convert it over to a Roth. You have two accounts, a traditional IRA and a Roth IRA, contribute to the traditional, and then a day or two later convert it over to the Roth, and now you've essentially worked around the Roth contribution limits. If you do make a contribution, a non-deductible contribution to your traditional IRA, that has to be tracked through a Form 8606. So it does require, because what you're going to have is you're going to have a traditional IRA which holds both pre-tax contribution that grows tax deferred, and it's also going to hold post-tax contribution that also grows tax deferred. That's why it's really smarter to just, whatever you contribute to your traditional IRA post-tax, just convert it to a Roth. But you have to do that conversion. If you do that conversion in a later year, if you don't do that in the same year, you will have to take, if you convert pre-tax to post-tax and from a traditional to a Roth, you will pay taxes on it. But if you didn't pay taxes on it originally, then you won't have to pay taxes when you make the conversion. I hope I didn't confuse anybody with that. If so, just ask the question. I'll straighten it out in the answers. So here's the contribution limits for Roth and traditional IRAs. 2016, 2017 haven't changed. You can contribute $5,500 up to age 50. If you're 50 and older, you get an additional $1,000 for a total contribution of $6,500. That hasn't changed between 2016 and 2017. Again, traditional IRA, you make that contribution of $6,500. You can deduct it from your taxes. It lowers your taxable income. If you make it from your Roth, you don't deduct it from your taxes, but it grows tax-free. So what is considered taxable compensation? It's, as it says in there, is generally what you earn from working. So it isn't passive income, right? It has to be sort of active income. So wages, commissions, bonuses, self-employment income, alimony counts on that, military pay, combat pay, et cetera, et cetera. What typically is not considered taxable compensation, if you own a property, if you own a rental property and you get you make money off of that, that doesn't count towards what is considered taxable compensation. Dividend, interest and dividend income, money from pension or annuity, and deferred compensation if you have self-employment loss, and then income from certain partnerships. Okay. So as far as making contributions, so you have until April 18th to make an annual contribution for 2016, and you can also make a contribution for 2017 anytime now in the year 2017 up until April. I'm assuming it's going to be April 15th of next year, but they give you up until tax return due date, not including extensions. Oh, by the way, when you make a contribution, if you don't state, if you want to make a contribution for 2016, like in our case, we have what's called a deposit coupon form where you fill out on there and you mark what year you're making a contribution form. If you don't mark it, then we automatically make it a current year contribution. It would be a 2017 contribution. A few other little miscellaneous things. My contributions to an IRA must be in cash, must be, a check. You can't contribute an asset into an IRA, so you can't make a contribution of a stock holding or a piece of property or anything like that. As we mentioned, the tax code limits the dollar amounts you can contribute each year. We went over that. The contributions must be postmarked before the April 18th date. So we don't necessarily have to receive it by April 18th. It just has to be postmarked. We look at the envelope when it comes in. And then when a contribution is made, then we submit a IRS Form 5498 to the IRS and send that to you as well. And it's available on, if you have an account with Entrust, it's available on when you log into your account. So some other ways to reduce your taxable income is if you're maxed out on your contribution, you can make a charitable gift to a nonprofit, maximize flexible spending accounts, and health savings accounts. For those of you who don't know what a health savings account is, you have to have a high deductible health care plan, and then you can open a health savings account and make a tax-deductible contribution to that. In 2016, that contribution, if you are single, is $3,350. In 2017, it's $33,400. And then if you have our family plan, it's $6,750, 2016, 2017. And if you're 55 or older, you get another $1,000. So difference between a health savings account and a flexible spending account. A flexible spending account, when that money, it typically gets deducted from your paycheck and put into account, and it's a use it or lose it type situation. You have to use it within that year or the money goes away. Whereas with a health savings account, which again has to be associated with a high deductible health care plan, so you have to have a high deductible plan in order to be allowed to open a health savings account. You make a contribution in that account and you can just grow the account. It's not a use it or lose it type situation. And so you grow it, you invest it in however you want to invest, and then when you use it, as long as you use it for health care expenses, then it is a tax-free transaction. So if you grow that account, so you put $3,400 this year in the health savings account, let's say you make really smart investments, it grows to $5,000, $6,000, and then you take some money out to use for health care expenses, you don't have to pay any taxes on the growth that occurred with that. And if you're able to grow, let's say you're young enough and you grow it, you grow it, and you grow it, and you reach a point where maybe it grows more than you necessarily need, if you take money out of that account and you don't use it for health care expenses, it's just treated like a traditional IRA. You now have to pay taxes on it, right? But it's not a use it or lose it type situation like a flexible spending account. And then obviously if you're part of a company plan and they have a 401k, you can contribute to your company's 401k plan and to reduce your taxable income. By the way, if you are covered by a company plan, if you're accompanied by a 401k plan, and that's the specific term the IRS uses, covered by, then any contributions you make to a traditional IRA are not going to be tax deductible. So again, it comes back to if you want to make additional contributions to an IRA and you're covered by a company 401k plan, just make the contribution to a Roth IRA rather than a traditional IRA because it's not tax deductible anyway. There's something called a saver's tax credit that if you're eligible, it's another way to reduce your taxable income. I don't know a lot about it, so if you ask me about it, I'm probably not going to be able to answer. And make the maximum traditional IRA contribution if you're eligible for the deduction. So just real quickly, a little self-promotional. What is a self-directed IRA? As I mentioned, the individual investor makes all the investment decisions, and you can hold alternative assets. You're not limited to traditional stocks, bonds, and mutual funds. In order for it to qualify as a retirement account, it has to be held by a third-party custodian or trustee. And an IRA, a traditional IRA, a Roth IRA, a SEP, a simple, which are business accounts, whether it's self-directed or not, are all governed by the rules of the Internal Revenue Code. So if you have a traditional IRA with Entrust or you have a traditional IRA with a traditional brokerage firm like Charles Schwab or Fidelity or whoever, it's the same tax rules, $5,500 annual contribution. Unless you're 50 or older, then you get additional $1,000. So a self-directed IRA is not a type of IRA. The types of IRAs are traditional, Roth, SEP, simple, et cetera, et cetera. Self-directed just means you can take your you make all the investment decisions and you can invest in whatever you want. If you're interested, if you don't have an account with us and it's something you're looking to do, just open an account. You can do that online through our website. Fund your account, typically either through an IRA to IRA transfer or a rollover from a qualified plan like a 401k, or you can make an annual contribution like we talked about. And then you instruct us what asset you want to purchase, be it real estate, precious metals, private equity, whatever you want it to be. And then the asset's held in the name of your account. Again, real easy to do. You can open the account in less than 10 minutes by going online. And we have a promotion going on right now up until April 18th that we typically have a $50 new account fee, and we waive that if you use the promo code PROMOTAX17. You have to do that through the online process, so go to the online, fill out all the information for your information. And then when you get to the end, to the pay port, you click a little button for code and then enter that in, and we waive the $50 fee. So just to summarize, you take control of your retirement savings. One way to do that is through self-directed IRAs. Again, April 18th is the tax deadline. If you want to make a contribution, it has to be postmarked by April 18th. Try and maximize your tax refund by taking advantage of retirement accounts. Contribute as much as you possibly can, and then again, getting started with an IRA, you can just open it and transfer or roll over and make an investment. Thanks again, everybody. Thanks for joining.